In order to get your dividend snowball rolling as fast as possible, yes, you do have to buy dividend stocks, and yes, you do need to reinvest your dividends, but also you ideally need to be buying stocks that are constantly increasing the amount they pay out in dividends. So in this video, we're going to be looking at 7 different dividend stocks that just recently announced dividend increases. If you'd like to be able to download any of the spreadsheets used to analyze these stocks, then you can head over to tickerdata.com at the link in the description. Now let's go ahead and dig in. And the first dividend stock on our list is actually one that I own in my personal portfolio, and it's a pretty high yielder, and that is Enterprise Product Partners, and they announced a dividend increase of 1.9%. Now, something I always like to point out, anytime we see a stock increase their dividend payout at a rate below inflation, then they're technically paying out less in dividends than the year prior. So that is something to keep in mind. Now, if we jump over to Seeking Alpha, we can see year to date, this company's actually done really well, up around 12.18%, and over the past year, up close to 9% now. So that's pretty decent. And actually, like I said, if we jump over to my do-it-yourself investor toolkit, blow up my growth chart, we can see this is a position I'm currently up close to around 48% on. Now, if we jump over to our dividend breakdown sheet, we'll come up here, plug in EPD, and hit enter. And this data will load in. Now, like I mentioned earlier, the starting dividend yield is pretty high for this company. It's sitting at about 7.10%, which does somewhat make the lower dividend increase a little bit more acceptable, but typically I still like to see higher dividend increases. Now, we have to understand, this is an energy stock, and more specifically, it's an oil stock. Earnings and free cash flow from these companies are pretty cyclical a lot of the times, and typically I like to pay attention with energy companies to the earnings payout ratio just a little bit more, but still the company uses most of their earnings to pay out dividends, payout ratio of about 78% as of right now. Now, they do have a history of increasing dividends, which is something to take into consideration, and we can see a 5-year dividend CAGR of 3.65 and a 10-year dividend CAGR of 3.92%. Now, I do want to point out this company is a little bit more expensive than it was just a year or two ago. Again, over the past year, up about 9%, but if you zoom out 5 years, we can see there was a time when this company is trading as low as around $20 per share. So again, that's around when I added, and I'm up around 50% on this position, but as of now, it's quite a bit more expensive. The second stock on our list is Ryder. That is stock ticker R, and they just announced a 14.1% dividend increase. So that is a pretty big boost to the dividend payout. And if we look at them over the past year, they've actually done really, really well. They're up nearly 44%, and if we look at them year to date, up close to around 13%. If we go ahead and jump over to our dividend breakdown sheet, let's come up here and plug in R, and we can see this company has a starting dividend yield sitting at about 2.15%. Now, the 10-year dividend CAGR is sitting at about 7.18%, and the 5-year dividend CAGR sitting at about 5.24%, and we can see they have a pretty decent history of increasing those dividend payments over time, but this most recent dividend hike, that was a really big one at around 14%, so quite a bit higher than the 10 and 5-year average. Now, if you're looking at these other charts, you're probably wondering what's going on. Look at the free cash flow versus dividends payout. Free cash flow is negative for most of the past decade with the exception of 2020. So what's going on here? Well, this is a company that operates in the industrial sector. And right now they have pretty high capital expenditures due to higher investments in their lease fleet. But if we jump back over to Seeking Alpha, let's go ahead and look at the financial statement. If we click on cash flow and scroll down, one of the things we can see is cash from operations from this company looks decent, and it has been growing over the past decade. But again, yes, capital expenditures have been pretty high over the past decade, so it is sustainable short term, but over the long term, I don't expect this to remain the same. The third stock that recently increased dividend payouts is a Dividend King, and keep in mind, a Dividend King is a company that's been increasing dividend payouts for over 50 consecutive years. So a lot of the times when people hear this, they think, oh, this must be a pretty great dividend paying company, and sometimes that is true, but that's not always the case. And what we can see here is Stanley Black & Decker. They announced around a 1.2% dividend increase. So that's a very low dividend increase, again, below the rate of inflation. Definitely not something that I like to see if I'm a holder in this company. And if we jump over to Seeking Alpha, we can see they're currently trading at $89.57 per share, and over the past year, down around 7%, and over the past 5 years, down 41%. So yes, a very low dividend hike, but if we jump over to our dividend sheet, let's see what that starting dividend yield looks like. We'll come up here and plug in SWK, and we can see they have a pretty decent starting dividend yield, sitting at about 3.62%. But even then, I'd like to see a much higher starting dividend yield if I'm going to see low dividend increases. Ideally, I want to see a decent yield with high dividend growth, and this one just really doesn't seem attractive to me. We can see free cash flow has declined pretty significantly, especially over the past few years, and in 2022, they actually had negative free cash flow. Not a good sign, and it's probably a pretty big reason why the stock has plummeted so much over the past few years. Now again, they are a Dividend King, so we can see a history of increasing those dividend payments, and they have a 10-year dividend CAGR of about 4.73%. But overall, I think there's better dividend kings out there and definitely better dividend growth opportunities out there. The next stock that just announced a dividend increase is Union Pacific Corporation, and they announced a 3.1% dividend hike. If we jump over to Seeking Alpha, they're currently trading at $235.35 per share. If we look at the past year, they're up around 9%, and year to date, looks like they're actually down slightly, down around 3.35%. We jump over to our dividend breakdown sheet, plug in UNP, and we can see the starting dividend yield for this company sitting at about 2.28%. Now, this most recent dividend hike, again, it was sitting at 3.1%, which is quite a bit lower than it has been over the past decade. We can see 10-year dividend CAGR of close to 11%. That's really good dividend growth, and we can see over the past 5 years, it's sitting at about 7.7%, which is also pretty solid. If we look at where they were in 2013, they're paying out about $1.48, and as of right now, they're paying out $5.36. So that's a lot of dividend growth over the past decade. So this most recent dividend hike, again, quite a bit lower. Now, why was this? Well, if we come over here and look at free cash flow versus dividends paid out, we can see free cash flow has been declining a little bit over the past couple of years, while dividends have been increasing, which means we see an increase in the free cash flow payout ratio. At the end of 2023, the free cash flow payout ratio was sitting at about 66.5%, when we can see for the majority of the past decade, looks like it was sitting closer to around 50%, a much healthier range. Now, keep in mind, if we jump over to our stock screener, plug in UNP, one of the things we have to point out is they don't just reward shareholders with paying out dividends, but they are heavily buying back shares. Come look at this. Shares outstanding in 2013 was sitting at about 927 million, but they bought back so many that in 2023, this was all the way down to 609 million. So that is significant share buybacks during this time period. That's nearly 1/3. Our next stock that just increased their dividend payments is PPG, and they announced a 4.6% dividend hike. And if we go to Seeking Alpha, they're trading at $125.94 per share. The past year has been pretty rough for them. They're down around 14.33%. They actually had a pretty good run up earlier in the year, but they've lost all of those gains since. If we look at them year to date, looks like they're down nearly 16%. So compared to the S&P 500, that's down by a pretty large amount. If we jump over to our dividend breakdown sheet, come up here and plug in PPG, we can see this company has a starting dividend yield sitting at about 2.09% and a 10-year dividend CAGR of around 7.22 and a 5-year dividend CAGR of 5.84. And it looks like the dividend growth has been pretty stable and pretty predictable. Something that I think is pretty underrated by most dividend investors is predictability when it comes to the dividend growth. This chart looks pretty good overall. If we look at the 10-year free cash flow, it's a little bit lower, sitting at about 3.85%, but that's basically because we can see this looks pretty choppy over that 10-year time period. The 5-year is sitting at about 12%, but that's because we can see free cash flow in 2018 was actually even lower than it was in 2013. But it has since recovered. 2023 was a pretty good year for free cash flow for the company. They generated around $1.8 billion, while dividends paid out was sitting close to around $600 million. And the end result of this was they saw a free cash flow payout ratio of around 32.12%. That's very healthy. And then we have stock ticker CTAS, that is Cintas Corporation, and they had a huge dividend increase, 15.6%. That is a large dividend hike. And if we look at them on Seeking Alpha, over the past decade, it's pretty unbelievable what they've been able to do. They're up over 1,100%. If we look at them in the past 5 years, up 189%, and over the past year, up over 46%. So this stock has been sneaky good over the past decade and over the past year. Doesn't get talked about a whole lot, but if we jump over to the dividend breakdown sheet, let's come up here, plug in CTAS, and what we'll see is a picture of a quality dividend growth company. Here's what we can see. Yes, very low starting dividend yield, sitting at about 0.83%, which yes, this would turn away a lot of dividend investors, but you have to get past simply looking at the dividend yield. Look at the dividend growth also. Over the past 5 years, they have a 5-year dividend CAGR of nearly 20%. Over the past 10 years, dividend CAGR of nearly 14%. Those dividend payments have gone from just 77 cents per share all the way up to $5 in 2023, and now $6.24. Those are massive dividend hikes. And keep in mind, the free cash flow payout ratio has stayed in a healthy range for the entirety of this time period. A lot of the times if we see a stock constantly increasing their dividend payments, but the free cash flow payout ratio is also increasing, it's not nearly as advantageous as we would think. But if the free cash flow payout ratio is staying the same or even going lower, that's a great sign. Again, we can see that free cash flow payout ratio staying close to around 30 to 35% for the past 7 or 8 years. And the reason behind this is we can see massive free cash flow growth. Look at this. Free cash flow in 2013 sitting at about $336 million, and in 2023, over $1.26 billion. Meanwhile, the dividends they paid out was only sitting at about $450 million. And what this does is it leaves plenty of free cash flow left over to do things like reinvest back into the business, pay down debt, or even buy back more shares for the company. If we jump over to the stock screener and plug in CTAS, again, we're going to see signs that this is a quality company. Top lines are growing. Look at revenue per share. Look at earnings per share and free cash flow per share. And like I said, they're also buying back shares. Look at that. Sitting at 124 million just in 2013, but in 2023, all the way down to 101 million. And anytime a company is buying back shares, it's going to boost all of their per share metrics like earnings per share, revenue per share, free cash flow per share, and even helps them pay out more in dividends per share. We can see the debt to assets has remained in a healthy range, and return on invested capital was actually pretty high in 2023, sitting at about 22%. So clearly there is a lot to like about this company, and if we quickly glance at the profitability spreadsheet, we can see pretty solid gross profit ratios. The 10-year average sitting at about 44.6, and in 2023 it was even higher, sitting at 47.34. So there's a lot to like about this company when looking at the fundamentals, but I will say if we look at the free cash flow yield, sitting at about 1.65%, so that is fairly high, so the company's not necessarily trading at a cheap valuation. And then finally, the last company we're going to look at is Penske Automotive, and they had a pretty big dividend hike as well, sitting at about 11.5%. I love seeing those double-digit dividend hikes. If we jump over to Seeking Alpha, they're trading at $158.56 per share, and over the past year, they're somewhat flat, down by about 4%, and year-to-date, we can see down around 1.21%. If we go ahead and jump over to our dividend breakdown sheet, plug in stock ticker PAG, we can see this company has a starting dividend yield sitting at about 2.11%. Now, the dividend growth has been really good over the past decade. It's sitting at about 15.66%, and over the past 5 years, over 16%. Now, one of the things that a lot of people don't necessarily like about this company is we can see in 2020 they reduced their dividend payment, which was actually pretty common during 2020. Obviously, there was a lot of uncertainty during that year, but everything turned out okay for them, and they've been able to continue their rich history of massively increasing their dividend payments. Again, we can see they've gone from around 62 cents per share in 2013 all the way up to $2.78 in 2023, and now sitting at $3.34. So that is a lot of dividend growth over the past decade. Now, 2023 wasn't necessarily their best year, and in fact, it's the only year in the past decade where they didn't generate enough free cash flow to actually cover all of their dividend payments. So this will be something to keep an eye on moving forward if this company is on your watch list. But there you go, those are a few companies that just recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.